Chapter 6, we take a look at self-employment business income, and the emphasis of this chapter is on Schedule C, which is found on page 1 of Form 1040. So the take on this chapter is a little bit different than what we've studied so far in the previous chapters. But the businesses that we're referring to then, or trades, are activities engaged in for a profit, and these are by non-corporations. So these businesses are non-C corporations. As we learned in financial accounting, the cost of goods sold is a reduction from sales to produce the first calculated line item on an income statement, which is gross profit. Also, if a company deals with inventory and it's a materially significant part of their income, then the entity, the business, must use the accrual method of accounting. So what is a deductible expense? Deductible expense then is an expense that is ordinary to the business or typical, necessary, that is to say they're required in order to generate income, which is why we incur expenses to generate income, and then necessary. They're appropriate and helpful rather than essential. So reasonable expenses talk about the amount of the expense in relation to their purpose. So the expense has to be reasonable given the benefit derived from the expense. Certain kinds of expenses are never deductible. Bribes and kickbacks or other illegal payments are not deductible. Lobbying and political expenses from a small business are not deductible, and neither are penalties and fines. None of these would satisfy the conditions of ordinary, necessary, and reasonable. Another expense that can be a major component of the expense structure for a business that is very capital intensive is depreciation. So I introduced the term basis earlier in an earlier video, and basis begins with the initial basis is the cost of the asset, and then we adjust that basis over time, and one of the primary ways we adjust the basis is by depreciation, and we record depreciation based on its asset class lives, which the IRS provides in tables we'll be discussing shortly. The depreciation convention, there are three: half-year, mid-quarter, and mid-month. Half-year convention is typical, the most common. No matter what time of the year an capital asset is purchased, for example, it is assumed that that asset has been purchased in the middle of the year, in the very first year. Mid-quarter convention applies when more than 40% of the assets have been purchased in the fourth quarter. Then it's assumed that those assets are purchased in the mid-quarter of whatever period they were purchased. And then the mid-month convention applies to real estate, and which uses the straight line method. And so in real estate, it's presumed that the asset, no matter when it's purchased during the month, the real estate was purchased in the middle of the month. So the accelerated depreciation methods that apply to many non-real estate assets are either 200% or 150% of straight line. As I mentioned earlier, this depreciation would be reported on Schedule C, which is for small businesses, Schedule E for self-employed people, and would be found on Form 2106. These are some of the more common depreciation periods, so that, for example, a racehorse or specialized tools, these income-producing assets would be depreciated over 3 years. Furniture, fixtures, and equipments, for example, would be depreciated over 7. Residential real estate over 27.5 years. And then non-residential real estate, such as commercial property, over 39 years. Autos and trucks and computers, a very common depreciation classification, is depreciated over 5 years. And as I mentioned, real property is depreciated not on an accelerated basis, but on a straight line basis. I discussed earlier the three conventions. The year of disposal, the convention is the same as in the year, and then it should say as in the year of acquisition. So if you purchase the asset and you purchase it using the half-year convention, then upon disposal, it's assumed that it was disposed of at the midpoint of that year. The depreciation methods for personal property, for example, non-real estate property, if it's 200% of straight line or 150% of straight line, it switches to straight line when the accelerated depreciation produces a result that's less than straight line. Another opportunity for businesses to, in this case, expense their equipment or income producing assets is using Internal Revenue Service Code Section 179. Section 179 allows immediate expensing of whatever asset's been purchased that year, even before the depreciation process begins. And so in 2017, the maximum expensing under Section 179 was $510,000. Section 179, however, cannot create a net operating loss, so we could only expense the capital asset down to zero. Another opportunity for businesses is the bonus depreciation. So after the Section 179 has been taken advantage of and has been expensed if it's available and if it's used, then there's a 50% bonus depreciation. And this depreciation really allows more depreciation, accelerated depreciation, to be taken against the assets. That is to say, the 50% of the entire depreciation can be taken in the first year. And then, by the way, after if a company has leveraged the use of Section 179 or the 50% bonus depreciation, then whatever is not depreciated would be subject to the accelerated depreciation, and the time period would depend upon its asset class. There are certain kinds of property that's used both for business and personal properties. For example, a computer that's at home may be used for personal purposes, and it may be used for business purposes. Auto is another pretty common example where a family's automobile may be used for business purposes and for personal purposes, and therefore the cost and depreciation would have to be allocated appropriately. Section 179 is not allowed for Section 179. And that is to say, if the property is not used more than 50% for the business purposes. So if I have a car and I use that car, say 40% for my business, 60% for personal reasons, I may not take advantage of the Section 179 expensing of the cost of that asset. That would lose that. So this is something that small businesses may want to consider. If they use the asset, especially a large purchase asset more than 50%, then they could, if they chose to, they could take advantage of Section 179. Otherwise, if it's below 50%, they would lose that. And then straight line depreciation and not accelerated depreciation would be used for property that is listed property, I should say, that is used less than 50% for business. So there are two disadvantages then for using an asset for business and for personal purposes, that is to say listed property, when it's used less than 50% of the time. Other business expenses on Schedule C are travel expenses. Ordinary and necessary travel expenses related to the business are deductible. So transportation is different than travel under the IRS code. Transportation expenses involves getting from one workplace to another workplace within the taxpayer's home area, and travel refers to travel away from a home and generally requires an overnight stay.